Hey team, today is Tuesday, April 7th. Here's the mortgage market in plain English. Rates are not trending. They're whipsawing inside a pretty tight range. And the next big move is going to come from inflation data, not vibes. Let's talk numbers. Freddie Mac's weekly survey has the average 30-year fixed at 6.46%, and Mortgage News Daily's daily index is basically the same at 6.44% as of this morning. That's important because it tells us something. After 5 straight weeks higher, the market is pausing, but it's not relaxing. Here's why. Bonds are getting hit from the inflation side, and right now, inflation risk is being driven by energy headlines tied to the conflict around Iran and the Strait of Hormuz. That's the story behind why mortgage rates jumped from 5.98% in late February to the mid sixes today. At the same time, the US economy isn't rolling over. The March jobs report came in at 178,000 new non farm jobs, unemployment 4.3%, and wages are still growing. Translation: the Fed doesn't feel forced to ride in and cut rates fast. And when the Fed can stay patient, mortgage rates stay sensitive to every inflation print. So here's the tactical setup for the week. Wednesday, we get the Fed minutes, and Friday, we get CPI. If CPI comes in hot, lenders can reprice worse quickly. If CPI comes in cool, mortgage rates can improve. But you still have to catch the move because volatility means the window can be hours, not days. Now, what does this mean for you in the field? One, run a CPI game plan with every active borrower. If they're closing soon, define the risk in advance. Do you want certainty or do you want to gamble on Friday's CPI? Your value is helping them choose a lane. Two, lean into purchase execution. MBA data just showed total applications down over 10%, but purchases were down only about 3%. FHA and VA demand is holding up better than conventional. So this is a great week to sharpen your government loan talk track and your payment strategies. Three, go on offense with agents. Zillow data shows newly pending listings up year over year and a big jump month over month, and more sellers are cutting prices. That's your opening to pitch negotiated concessions, temporary buy downs, and price plus rate strategies. In a more inventory market, the best loan officer is the one who brings solutions, not just a rate quote. Last thing, encouragement. This is still a relationship business. When rates are noisy, borrowers and realtors don't need a fortune teller. They need a calm pro with a plan. Be the person who shows up this week with clarity, options, and speed.
So that's where things stand today. Look, this market isn't easy, but there's still a real opportunity for the right people with the right support and the right approach. I truly believe that independent mortgage professionals can still win in this environment, but you have to be aligned with a company that gives you the tools, the flexibility, and the support to compete. If you'd like to learn more about how Central Coast Lending supports our loan officers and helps them stay competitive in today's environment, simply give me a call. I appreciate you spending a few minutes with me today, and I'll see you on the next update.
To connect, my contact information is on the screen. I look forward to hearing from you.